In the realm of economics, understanding the ebb and flow of markets is paramount. Enter the Benner cycle, a long-term economic theory that posits the existence of cyclical waves spanning roughly 60 years. This theory, named after its proponent Samuel Benner, offers a unique perspective on economic fluctuations. It suggests that these cycles are not random, but rather follow predictable patterns, impacting everything from commodity prices to stock market movements. By grasping the principles of the Benner cycle, investors, policymakers, and businesses alike can gain valuable insight into the forces shaping our economic landscape. As always, please remember we do not provide financial advice. The material covered is either for information purposes or for fun only. Now that's out of the way, let's dive in. Economic cycles are the heartbeat of our financial system. They represent periods of expansion and contraction, boom and bust, that influence investment decisions, government policies, and ultimately our daily lives. Recognizing these cycles is crucial for informed decision-making. Just as a seasoned sailor anticipates shifting winds, understanding economic cycles allows us to navigate financial waters more effectively. Whether planning for retirement, making investment choices, or setting business strategies, awareness of these cyclical patterns is essential. At the heart of the Benner cycle lie three key drivers: agricultural patterns, market speculation, and inherent cyclical trends. These elements intertwine to create a complex web of economic activity that has been observed for centuries. Agriculture, being the foundation of economies for centuries, plays a pivotal role. From ancient civilizations to modern times, the success of harvests has dictated the prosperity of societies. The Benner cycle suggests that agricultural cycles, driven by factors like weather and demand, influence commodity prices and overall economic activity. A good harvest can lead to lower prices, while a poor one can cause prices to spike, affecting everything from food costs to trade balances. Market speculation, the engine of booms and busts, amplifies these cycles. Speculators, driven by the potential for profit, can drive prices to unsustainable levels, creating bubbles that eventually burst. Driven by fear and greed, speculation can lead to asset bubbles and subsequent crashes, further influencing the cyclical pattern. These dramatic shifts can have far-reaching consequences, impacting not just investors but entire economies. Lastly, the Benner cycle recognizes the inherent tendency of economies to move through periods of growth and contraction, influenced by factors like demographics, technological innovation, and government policies. These factors can either mitigate or exacerbate the natural economic cycles, shaping the future of societies. History is replete with examples that resonate with the Benner cycle's predictions. The Great Depression, a period of unprecedented economic hardship, aligns with a downswing in the cycle. The post-World War II economic boom, characterized by rapid industrial growth and rising living standards, mirrors an upswing. More recently, the 2008 financial crisis, triggered by a housing bubble and excessive risk-taking, reflects another cyclical downturn. These historical parallels highlight the enduring relevance of the Benner cycle in understanding long-term economic patterns. Forecasting market shifts, navigating the waves of the Benner cycle. Proponents of the Benner cycle argue that it provides a framework for anticipating market changes. This cycle, named after Samuel Benner, is based on historical patterns and economic data, aiming to predict the ebb and flow of market conditions. By identifying the current position within the cycle, investors can potentially adjust their portfolios to capitalize on emerging trends. This strategic adjustment can help in maximizing returns and minimizing risks associated with market volatility. For example, during an upswing, investments in growth-oriented sectors like technology or real estate might be favored. These sectors often experience significant gains during periods of economic expansion. Conversely, during a downswing, a focus on defensive sectors like consumer staples or healthcare might be more prudent. These sectors tend to be more stable and less affected by economic downturns. However, it's crucial to remember that the Benner cycle, like any economic theory, is not foolproof and should be used in conjunction with other analytical tools. Diversifying investments and staying informed about global economic indicators can further enhance decision making. Advantages and limitations of the Benner cycle. The Benner cycle, like any theory, has its strengths and weaknesses. It offers a unique lens through which we can view economic patterns and trends over extended periods. One of its primary advantages is its ability to provide a big picture perspective on economic fluctuations. This macro-level view can be incredibly insightful for understanding the broader economic environment. By focusing on long-term cycles, it helps to filter out short-term noise and identify overarching trends. This can be particularly useful in distinguishing between temporary market volatility and more significant, enduring shifts. This can be particularly valuable for long-term investors and policymakers. They can use these insights to make more informed decisions that align with long-term economic cycles. However, a significant limitation is its lack of precise timing. The Benner cycle provides a general sense of when economic shifts might occur, but falls short in offering exact dates. While the Benner cycle suggests general timeframes for economic shifts, it does not pinpoint exact dates, making it challenging to time market entries and exits accurately. This imprecision can be a drawback for those looking for exact timing in their financial strategies. This lack of precise timing can lead to missed opportunities or premature decisions, adding a layer of complexity to financial planning and investment strategies. The Benner cycle's track record. The accuracy of the Benner cycle is a subject of debate among economists. While historical data shows some correlation with the theory's predictions, there are instances where the cycle has not perfectly aligned with real-world events. Critics argue that economic cycles are influenced by a complex interplay of factors, making it difficult to isolate the impact of any single theory. Furthermore, the Benner cycle's long time frames make it challenging to empirically test its validity. Despite these criticisms, the Benner cycle continues to intrigue and provoke discussion, prompting further research and analysis. The Benner cycle in the 21st century. Implications of globalization, AI, and automation. The 21st century has ushered in an era of rapid technological advancement and globalization, adding new layers of complexity to economic forecasting. The rise of artificial intelligence, automation, and interconnected global markets undoubtedly influences economic cycles. Whether these forces will amplify, dampen, or fundamentally alter the Benner cycle remains to be seen. However, understanding the theory's core principles, particularly the interplay of agriculture, speculation, and cyclical trends, can still provide valuable insights into these evolving dynamics. Riding the waves of change. Key takeaways and the importance of economic awareness. The Benner cycle, regardless of its absolute accuracy, underscores a crucial point. Economic cycles are a reality. Understanding these cycles, even in their broad strokes, can empower individuals, businesses, and policymakers to make more informed decisions. While the Benner cycle provides one lens through which to view these fluctuations, it's essential to cultivate a broader awareness of economic trends. By staying informed, staying financially literate and educated, seeking diverse perspectives, and adapting to changing conditions, we can navigate the complexities of the economic landscape with greater confidence and resilience. Let me know your thoughts in the comments. Thanks for hanging with me. If you liked this video, you're going to love the one on your screen right now. It's packed with even more great information for you to enjoy. Click it and we'll see you on the other side.